All right, welcome back. My name is Patrick Dunawilla. I'm the editor of the Chart Report. Sitting down with us today is Steve Straza of All Star Charts. Steve, I know you got a lot to share with us today, so let's get right into it. You had your weekly RPP report, which is kind of your weekly State of the Union. A lot of good stuff in there. Let's start off with the broader market. The S&P 500 just logged its 7th consecutive monthly gain. It's up 9 of the last 10 months. So just really unusual strength there. We are entering what has notoriously been the worst month for the S&P 500. September, over the past 20 years, the S&P 500 has actually lost about 80 basis points in September. But seasonality really hasn't mattered at all this year yet. So I'm just wondering, how are you kind of thinking about that, just unusual strength, and do you think it's time for some pause? I know you shared this one chart with me and said, Pat, we got to talk about this. It's a great chart. You have the fib levels from the great financial crisis, but tell me kind of how you're looking at it and what you see on it.
So I would argue seasonality does matter, and it has worked this year. And by that, I'm talking about election cycle and election year seasonality. So if you go back to this chart, I've highlighted with yellow circles every election month going back to 2012. So when Obama was elected in November 2012, we saw 20 out of 25 up weeks before we got back-to-back up months, before we got back-to-back down months. Then when Trump was elected in November 16, we saw 14 out of 15 up months before we had back-to-back down months. Right now, our current streak, which also began in November of 2020, when Biden was just elected, we're at 9 out of 10 up months right now. The other interesting thing about this is that during these election years, they tend to have those back-to-back down months right at key Fibonacci's, which you can see right in this chart. So the question I'm kind of asking myself is it time to have back-to-back down months? Maybe there's some rotation into small caps and mid caps here. Does price react to this Fibonacci extension similar to how it has in the past?
Yeah, I mean, I think that's a really interesting point, because one thing that I've been thinking about all year has been how similar 2021 is so far to 2013 and 2017. And what do those 2 months, or what do those 2 years have in common? They're both election years, right? And it's both, they were similar in the fact that it was just this steady low vol bleed up, right?
And it is a very orderly rally.
Yeah, exactly. Just very low volatility. The most we've gotten is 4% pullback this year. So you shared this chart, which I think is really interesting, and that kind of hammers home the point that, after September in those post-election years, you do see a bit of a stumble there. Right. And as you pointed out, we're right at that major Fibonacci level too. So you would basically be a little cautious here. Is that fair to say?
I mean, listen, this is just one data point. I'm not Mr. Seasonality. I follow price. If seasonality is confirming what I'm seeing, great. If not, I'm still looking at price. But yes, we're hitting a key fib. We had that 9 out of 10 up month. It's been a nice run. And like you said about September, we just entered September. You could see in the blue line, this is every election year going back to 1950. So you see that weakness into the fall. Do we see it again here? If we do, it would be nothing abnormal, right? It wouldn't be like sell everything, the stock market's going to crash. It would be, okay, maybe stock's correct for a little bit now.
Right. And another point that you made in the note was basically that we have to look at all this in the context of some of the other really big bullish developments going on. You mentioned financials breaking out, of a multi-decade, or not multi-decade, multi-year base. So
it was like a 14-year base breakout, and then it was like a base on base breakout, and we're just still ripping.
Right. So basically, so what are your favorite areas of the market in terms of industry groups and sectors? What is kind of standing out to you? I know real estate's been on an absolute tear this week, led the past 3 days. Today you're seeing a little bit of give back, but is that one on your radar? Or?
I wouldn't be buying real estate here. The chart looks fine, but we're seeing, and like you said, there's a lot of great areas that are doing very well right now. Staples are at all-time absolute highs, but they're also at record lows on a relative basis. I wouldn't want to get into the defensive sectors right now or the bond proxy sectors right now. I would be more interested in the risk on groups. Tech is just Teflon and doesn't stop. So you have to, big shout out to tech and communications and growth. Even down the cap scale, we're seeing strength there. Small cap tech and small cap growth are the first areas within the small cap complex to make new all-time highs. I don't think that's bearish at all. But in terms of the large cap sectors, I mean, there's all-time highs everywhere, and there's pockets of strength within these sectors. So I'm not really particularly focusing on any one in particular. The relative trends for these sectors are still kind of messy across the board. Financials have been the best performing sector over the trailing quarter, followed by communications. I would be looking at those areas. And I really think if we're going to move higher from here and see another leg up, it's the cyclical groups that you really want to be in. I think that's where the catch-up trade is going to be.
Yeah. Another really interesting point you had in there, so large caps and small caps, we talk a lot about them, but mid caps, you had a really interesting chart of mid caps in there. Do you want to speak to it here? You got kind of like a bull flag going on there.
So this is the beauty of zooming out, right? This is why we do this. This is why we look so forward to our monthly candlesticks every month. When you really take a step back and focus on the structural trends at play, things become a lot more clear, right? You look at mid caps on a daily chart. It's been a hot mess all year. When you zoom out, that's a high and tight flag. That's about as bullish as it gets. That, you got to treat that kind of pattern as innocent until proven guilty. It very likely resolves higher and heads up to that 728 level.
Yeah.
And imagine what the rest of the stock market's doing under those circumstances.
Right. And, another piece of bullish evidence you have there is the fact that all those economically sensitive areas of the market, I'm talking home builders, semis, those continue to do absolutely fine. They look great, right? So that is another thing that's keeping us kind of not totally bearish, right, at the moment.
I think those are great points. I mean, what we like to look at, right? Our modern Dow theory. Transports aren't doing it right now. They're not confirming what we're seeing from the major averages, but semis are. And for me, that's plenty good. Semis are, the lubricants of the global economy. I'd rather.
What is it in transports that's lagging so hard? Is it the airlines? Is it the rails?
It's airlines and it's logistics. Really.
Oh,
it's the FedExes, the UPSs, the Delta Airlines. They're garbage. What's interesting about transports is when you look down the cap scale to the mid cap and small cap transports, mid cap transports just made new all time highs. Small caps have been trending higher. So
say that again. Mid cap transports just made
all time highs.
And large cap transports they're still at least 5% below their all time high probably.
And it comes down to the composition of these indexes. The large caps are the airlines, they're the railroads, they're the UPS, FedEx, the logistic companies. The mid caps and the small caps are more your marine transportation stocks. They're by nature, they're not large companies. That's where the alpha is in the transportation industry right now. Marine shipping. And the Baltic Dry Index is also at 10-year highs. So there's no coincidence.
Yeah, do you want to speak to that a little bit? I was talking to a friend about that and kind of asking him, like, is this something that matters to you? Do you look at the Baltic? What does it mean? Do you want to just touch on that real quick?
Yeah, it's actually it is a price index of different inputs that are used for marine shipping and transportation. So when the Baltic Dry Index is moving higher, typically means that goods are moving around the global economy in a bullish way, right? When
shipping prices are high, there's demand. That means things are moving. The goods are moving.
It speaks to healthy demand for shipping goods around the world.
All right, and the last topic I want to get on today is commodities, right? You have this great chart here showing
so hated. What's with these poor things?
So this chart here shows DBC. That blue line is the commodities index, orange line is stocks, and the purple line is bonds. And I think a lot of investors are underexposed to commodities, and rightfully so. I mean, for starters, they've done terrible for the last 10 years, so it's been dead money.
Bias.
Yeah, but also they require more active management than something like stocks or bonds. So they're kind of out of favor in this era of passive investing and buy and hold. Would you agree?
They also require a futures account, which a lot of people, maybe most your average investors don't have, right?
Right. And so the bottom line is commodities are stocks are doing great. Stocks are having an above average year, but commodities are really, really where the story is right now.
They've been
And this
outperforming since crude went negative last year.
yeah, and it's funny because like the most popular commodity in terms of your average investor that they're most familiar with is probably gold, and gold's done terrible, relatively terrible this year. It's down like 4%, and meanwhile the commodities index is up like 30.
Right.
And
you want to
and
be in
what
the
are
risk
big weights
on
in the
commodities,
commodity index?
just like anything else. It's a bull market. You want to be in the risk on commodities. Precious metals, by nature, just like we talked about with these defensive sectors, precious metals are a safe haven, right? And that's the kind of stuff that's not working right now.
Right. So what are some of those big commodities in the commodities index that are pulling that strength?
Steel,
Is it crude oil
nat
mostly?
gas, crude. Copper doesn't look bad, but there's a handful of other base metals and industrial metals that look much better. The ags have been starting to work, softs, grains. There's very broad-based strength in the commodities complex. We do a note every Friday. Ian does a great job at that, and we're constantly saying to each other, like, wow, this one's breaking out, another one's breaking out, another one's breaking out, whether it's lean hogs or oats or whatever it might be. But commodities have been good to us this year.
Yeah.
And this chart is great too because it speaks to the sentiment.
Right.
I'm not a big fund flow guy. It's always, I can't, this is another one of those data points which is like, whatever. But it does show you that people are probably very much underinvested in this space, right? And what do fund managers do? They chase performance. And where's the outperformance? It's in commodities. So I would expect that bar chart to look a lot higher this time next year.
So you think it's kind of like a momentum thing, basically, like the fact that they're having just a good year. I mean, they haven't even had a good year, a decent positive year in a while. So that momentum could kind of carry that trend is what you're saying.
Yeah, eventually people are going to have to chase that alpha.
So you don't think that it's just like an aberration, they had their moment in the sun and then they go away and commodities are terrible for the next 5-10 years.
You don't No, you don't see these slingshot patterns like we've seen all over the place for commodities unless there's something special going on usually, right?
Yeah. And how poetic is it that it kind of all started with crude oil going negative, right?
It's perfect. It's absolutely perfect, right? We love it. There's plenty of good quotes about it, but typically new bull markets will start from a position of, people being
absolute
afraid.
Panic, absolute capitulation kind of thing, right?
And that's exactly what we had, right? So the sentiment is in place, the price action is in place, the outperformance is in place, the relative strength. There's a lot to like about commodities. The internals, breadth for commodities, like underneath the surface, just the participation is just incredibly constructive. There aren't many bad things I could say about commodities outside of precious metals.
Awesome. Well, Steve, I can't wait to talk to you next week and get your thoughts then. Be well. I'll talk to you soon.
All right, brother. Thanks for having me. Peace.
All right. Take care. Bye.